Let's ask DoubleLine Capital CEO Jeffrey Gundlach. He is with me live today in a CNBC exclusive interview. Welcome back, Jeffrey. It's good to see you again.
Hey, Judge. Good to be back on Fed Day again.
Yeah, it sure is great to have you. We said it's a historic move today by the Fed. Your first reaction is what?
Well, I want to put it in context to start with. We all know that the Fed was far, far too dovish last September and perhaps into December. And then last Fed meeting, there was a lot of talk about we're going to get rid of inflation, we're going to bring inflation down, we're going to bring inflation down. And so we basically have those as the goalposts. We had way too dovish, and then we had a pretty strong commitment. And that was supported, of course, by short rates going up a lot, from only about 15 basis points for much of last year up to basically close to 3% on the 2-year. And as I've said in past appearances, the Fed always follows the 2-year. But the one thing the market was really worried about, and we thought at DoubleLine overly worried about, and I think it turned out to be the case, is that everybody knows that the tools of the Fed are very blunt. And if you want to put it a little bit derogatorily, it's almost like Mr. Magoo and his jalopy. And he's driving around, and he doesn't really know where he's going, can't see that well, but he knows when he's going to hit something, or after he's hit something, and the problem is there. And the markets were worried that Mr. Magoo was going to start accelerating in his jalopy in terms of perhaps talking about 75 basis points. And that's a speed that jalopy going along at might really legitimately cause concerns about a recession perhaps even this year. And I don't think that's going to happen. I've talked about that before. And so there's a relief rally for sure. One thing that hasn't been talked about is that the yield curve, the Treasury yield curve, has been bumping up against some pretty massive yield resistance for a while now, which is, the high on the 10-year was 3% back in 2019, 2018. The 2-year Treasury got up to about 3.25, and there's tremendous amounts of yield resistance there. So it's not surprising that we got a steeper curve. The long end can't seem to make up its mind on what to think because, there's certainly some economic slowdown that one has to think is baked into the cake here with the roll-off of all the durable goods and non-durable goods, consumer consumption, which is still very, very elevated and needs to come down very substantially to get back to trend, which had been convincing pre-pandemic. So we expected a rally. I mean, I do think that we may be seeing the high in the dollar now, that we're starting to get some relief from the short end of the yield curve. So I'll stop there, Judge, and let you follow up.
No, it's interesting because you really do allude to what I'm going to call the moment of truth today. And I want you to listen to this exchange from our very own Steve Leisman and the Fed chair because it ignited this rally. Jeffrey, let's listen and we can react on the other side.
You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible?
75 basis point in an increase is not something the committee is actively considering.
The moment of truth, wasn't it, Jeffrey?
Absolutely. I thought Steve just nailed that question. I was hoping that someone was going to ask it, and he asked it in such a direct way. I think that's commendable. Also, I commend Jay Powell for giving a fairly specific answer. And that's exactly what I'm alluding to, where I'm saying Mr. Magoo was not going to step on the accelerator and go crashing into a dumpster somewhere. So we're still in a Mr. Magoo situation because the tools are blunt, as Jay Powell himself admitted. But at least the 75 seems for real off the table, at least at the coming 2 meetings. And what the market loves always, Scott, you know this, everybody that's a
certainty
frequent watcher of CNBC knows, they want certainty. They don't want, right, they don't want overly hawkish talk. They don't want maybe a 75 showing up out of the blue. And you got a very crystal clear answer in that. That's when the 2-year Treasury yield just plummeted 15 basis points, and that was all clear for the stock market to start a pretty substantial short covering rally, which I think stocks were in a very similar position prior to this meeting as they were prior to the March meeting. And that is the VIX was very elevated. There was a lot of uncertainty and fear. And the VIX above 35, again, we talked about this in March, Judge. I said when the VIX is above 35, you're supposed to be getting less bearish, not more bearish. And indeed, that level turned out to be a good buy again. So it looks to me like the markets are probably going to be in a better position for the next couple of weeks than they were in the past month.
I flagged that exchange that we had on March the 16th, where you specifically referenced the VIX at 35. I don't care how bad the tape looks. I don't care how bad the geopolitics look, you said. You're supposed to get more bullish. VIX was at 35 the other day. Dropped down a lot from there.
It's down a lot today, and it should be, because that's what happens when you get a 1,000-point rally off of an uncertain period. So yeah, I mean, we talked about foreign stock markets. The European stock market continues to be a good performer. It's about the only area that's doing something positive. And interestingly, with the carnage that's in the bond market, in the corporate bond market, and in the emerging market, particularly the high-yield corporate bond market, it's amazing that the emerging market equities are doing as well as they're doing. It's a sign to me that, and I talked about this in March, still haven't bought emerging market equities, but we're taking a real hard look at it, because if the dollar falls, the dollar index may reject this triple top, which was 2017, 2020, and now 2022. And if it drops back below 102, I think that's the signal to buy emerging markets. We're not very far away. So we've owned Europe, we've owned commodities, we've owned the long bond, which has been the poorest performer of our diversified asset mix year to date. But I think all of these things, when you glom them together, this highly diversified portfolio approach that I've been recommending for 2 years now continues to work. And this year it's been driven by commodities. The commodities have been the performer that's good. Stocks are a mixed bag. Some of them are up a little, some of them are down. The NASDAQ's not very good. I haven't advocated the NASDAQ. And then still cash is there for tactical investing, like you might have wanted to invest some cash late last week. Because of the extreme situation on the VIX. So I feel like we're almost in the same spot as we were last March. It's been a little bit of a rocky road along the way.
It leads us to this question I asked at the very top of our program before I welcomed you into the show today. It's the multi-trillion-dollar question. It's, can the Fed pull this off? Can they do what seems to be so incredibly difficult? To that, Jay Powell obviously was asked directly about that. A good chance to have a soft or soft-ish landing is what he said. It's not going to be easy and may depend on events that are beyond our control, but he seemed to suggest that he's confident enough that they can pull this off. You've doubted that. Where are you today?
Yeah, I don't think that was his finest moment in the press conference. I mean, he has to say that. I understand that. But I thought by saying soft-ish, it sort of showed a little chink in the armor. I think he knows that the odds are not as good as 50-50 that he can pull off a non-recession in, say, the 18 months ahead. There's just too much normalization of the economy. My favorite chart is to compare durable personal consumption spending year over year, non-durable personal consumption spending, and service year-over-year personal consumption spending. And those three categories, which are all very different, went up in lockstep, almost exactly the same pattern and distance from point A to point B for the 4 years from 2016 into the pandemic. And then, of course, they all cratered. And then thanks to the government stimulus, we had an explosion of durable goods spending. It's up 30% above trend right now. And that's a very convincing trend that was in place for years. Non-durable spending is still elevated at 20% above trend for those years, and service is back to trend. So these are going to be very substantial headwinds for the economy in concert with the fiscal drag. So when I put all of that together with the yield curve, which has inverted, not for long, and is now de-inverting, I like to tell investors, don't start throwing celebrations when the yield curve de-inverts. The yield curve always de-inverts prior to recession. So it's not a sign that we're further from recession. The one thing you might take solace from with the yield curve is it stayed inverted for such a short period of time that you could say it might be a false signal. But I'm going to be watching the yield curve very, very closely. We're now at about 25 basis points, 2s, 10s. We were inverted. We've been about flat 5s to 30s until the 75 basis point Steve Leisman moment that you referenced. And now that's steepened out some. So we're going to be watching that very, very closely. But I think the 4 terrible months for bonds in terms of returns, I think that string is going to be broken here, hopefully in the month of May. But this has been one of the worst 4-month periods in the entire history of the Treasury and the investment-grade bond market, worse than any 4 months. Forget about year-end start dates. I'm talking about any 4 months ever going back to 1978. And we all know how volatile interest rates were in the late 70s. So I think we deserve a break from all of these negative bond trends. And I think Jay Powell's, I don't believe his assurances that he can pull off a soft landing. But the fact that he says it does reassure investors, or at least let me put it this way, it scares short sellers.
Is recession still your base case call? I mean, and I understand the difficult
Not this year.
task that he has. Not this year, but ultimately,
No.
even if it's in 23. I mean, Ken Griffin this week, Powell's in a very, very difficult position. He said, we're in perhaps the greatest period of uncertainty since the great financial crisis. That from Ken Griffin of Citadel this week. It speaks to the challenge that Jay Powell and company have in front of them.
And I had almost the exact same message that I took away from Paul Tudor Jones, who said almost the same thing. So I think we got a hat trick. I think Jeffrey Gundlach, Paul Tudor Jones, and Ken Griffin are in agreement that this is one of the toughest environments. I mean, here we are. It's better than it was, say, September to December of last year, when the stock market was so overvalued, and you knew that rate hikes had to come because the bond market was so far ahead of the curve, i.e. the Fed was so far behind the curve. And we knew quantitative tightening was coming. That piece of the puzzle was pretty clearly articulated, and that's going to be the one thing that challenges the system as we move forward. We do have double-barreled tightening going on, and while 50 sounds good when you're worried about 75, I heard from that press conference that there's 250s coming back to back, and the bond market pricing definitely corroborates that. The bond market thinks there's 350s coming in the 5 meetings that remain by year end. So,
but do you make the argument, too, though, that the markets have gotten ahead of themselves, bond market included? I mean, if you look at what the markets have factored in, it wouldn't necessarily mesh with what Mr. Powell just said.
The bond market has been displaying the early signs of late cycle activity. The yield curve flattening is a big piece of it. Credit spreads have been widening. Not in an alarming rate that's gotten a lot of attention, but even investment-grade corporate bond yields spreads are out by about almost 50 basis points. They probably narrowed in today. We're in a strange environment, Judge, where when interest rates rise, spread sectors, credit sectors actually widen in yield. That's pretty unusual. It's because we're at such a low rate level and there's so much perceived risk. And now, here in 2022, when you get a rally in Treasury bonds, against historical patterns, you get a tightening in spreads. Basically, when the bond market rallies, you're getting more confidence in liquidity. And that's what's been happening. So I expect we're going to see fairly positive returns, even out of the credit sectors in the bond market. I'm not talking about for the rest of the year. I'm talking about in the weeks ahead.
Well, it's interesting. I mean, you referenced Paul Tudor Jones, and to refresh people's memory on what he said also on this network, so much news has happened on this network this week. You don't want to be in bonds or stocks, said PTJ. Can't think of a worse macro environment than where we are now. So it sounds like you agree with the comment about the uncertain environment that we're in, but don't necessarily agree on where you can make some money, at least in the near term. Is that fair?
I think Paul Tudor Jones is a lot more aggressive than I am. And so I think that he's willing to take more extreme positioning. I'll reiterate, I still like the highly diversified portfolio with commodity exposure, which continues to work. I mean, it's incredible how the commodity markets, since we talked in March, are up about 7%. And that's with, for most of that time, a lot of risk assets not doing very well. So I still like a commodity position as much as a third of a portfolio. I like non-U.S. stocks. We've been using Europe. That's been doing well. That's one of the better performing sectors. And I like long-term treasuries only because we still have a recessionary risk and a deflationary risk. So the fact that you're losing money on the treasuries isn't really a reason not to own them, because if you do this blend of cash, which now should probably only be about 15%, commodities, long-term treasuries, and a variety of stocks, This has been a formula that's worked quite well. It's had a return of about 8% over the past year, and the past year hasn't been very good for a lot of portfolio positioning. And it's actually almost flat year to date, a mix like that, which is what we need. Paul Tudor Jones talked about capital preservation. I agree with that. I think there's various ways of achieving capital preservation. I like this diversified mix. Paul Tudor Jones probably likes, active trading more than I do, but he's more aggressive than I am. So anyway, that's how I see it, Scott.
Good. It is interesting, though. I mean, you have maintained what has been a 25, 25, 25, 25 allocation, for those who are playing at home and trying to figure out how to make their portfolios work the best for them, that being commodity stocks, non-U.S. bonds, and cash, each getting a 25% weighting. But now you're upping commodities to 35 and dumping cash down to 15.
Well, that's actually a move that I made a few months ago. But yeah, the 25, 25, 25, 25 thing is a good starting point. We move around that because we're on top of it every day, and a lot of investors have another job to do other than just following their own 401k and the like. But yes, I like that diversified mix. The worst performer in that mix has been the long-term treasuries, but it hasn't. But it's served us well during certain periods of market turmoil, and I think it can again.
So if we look at rates, since we're talking a bit about that as well, it's really amazing how far rates have gone, or how much the environment at least seems to have changed since we last spoke on the last Fed day, not that long ago, obviously, in March. The 10-year, and it's hard to remember that it was at this. The 10-year was at 217 when we spoke last.
Yeah.
Now let's call it 3%.
Yeah.
The 2-year has moved almost 100 basis points. It was at 193. And then it was at 280, until today, and we had the market move.
That's a really good comment, Scott, because we feel it the same way in our investment meetings at DoubleLine. You look at where we were in January, and you almost have to be in disbelief that that's how we started the year. The 2-year Treasury is up 200 basis points year to date. That's before the presser today, so it's probably up a little bit less now. The 5-year up 170, the 10-year up 150 year to date, the 30-year up 110 basis points year to date. So the curve broadly has flattened. But yeah, that move up in the 2-year was incredible. It was about 120 basis points over a 5-week period of time. And that's what got the Fed to really get religion about saying we have to stop pretending about this transitory inflation and just identify it for what it is and get moving. And the bond market was relentless in basically taunting the Fed into changing its policies. And it looks like the Fed has now placated the bond market to a certain extent. So again, your comment is excellent. It's hard to believe where rates were just a few months ago and how much they've moved. And like we said in March, I don't care, when the VIX is up a lot, when rates have already gone up a lot, that probably means that an awful lot of things have been factored into the situation. And so the bond market, I think, has found a local high in yields.
And frankly, I mean, you're looking into a camera, so you can't see the picture we're showing now as you're speaking. We're showing the curve, and we're showing where interest rates were. And as I was going back and watching our prior interview to prepare for today, we had the same thing on the screen. And I just marveled at where rates were not that long ago and where they've gone. And let's go back to where let's bring this full circle for a moment, if we could. And that is this idea of whether Powell can pull this off. And this notion of what you told me the last time, that you thought we were near peak inflation. And then when you were with Pisani down in Miami just a few weeks ago as well, you said, quote, I think we are near peak inflation. So if you think we are there, and Powell clearly does too, and there are certain parts of inflation that definitely seem to have rolled over, doesn't that mean that the Fed does at this point, even given the shot at their credibility, deserves the benefit of the doubt in some respects, that they're going to pull this off? That 50 and then 50 at minimum, or 50 net today, and then at the next 2 meetings, maybe they don't have to do as much if they're right. Yeah,
I mean, that's something to hope for, I guess. I mean, the problem is that inflation peaking, CPI is at 8.5. When I say inflation's peaking, I'm saying that maybe inflation can end the year below 6 on the CPI. So maybe that puts you in the high 4s on some other inflation measures. That's still a lot higher than today's interest rates. That's sort of what the issue is. So the fact that it's peaking is quite certain, I think, at this point. The next 3 months CPI month-over-month figures that are rolling off, so the ones from last year, 2021, the 3 months coming are pretty big numbers. I think they're 0.6, 0.7, and 0.9. And it seems quite unlikely that we're going to replace the CPI with those types of month-over-month figures in the 3 months ahead, which means that we probably will be looking at a 6 handle on the headline CPI come, say, Labor Day or something like this. And so that's good, but the real question is, will it fall back down anywhere close to, say, 3%, which is what you kind of need, I think, to believe that they can pull off this soft landing. Our methodology of analysis does not suggest that that's going to happen. And so I still think we have real problems with housing inflation, shelter inflation. I think wage inflation is still going to be a problem. But those other things, the base effects from 2021, they're assuredly rolling off and not going to be replaced with the same types of figures. So yes, inflation has peaked, but just peaking isn't good enough. It's got to come down somewhere into the context of where interest rates and sort of nominal GDP. I mean, one thing, Scott, I want to point out, because we've talked about this in many of my past webcasts and on the air with you, there's a couple signposts for the 10-year Treasury yield, which have been really helpful over the years. The first is the ratio of the price of copper in the futures market to the price of gold. And since the middle of 2020, it was screaming that interest rates on the 10-year Treasury were far too low. It was basically saying the 10-year Treasury should be at 3. Well, lo and behold, the bond market made an honest man out of the copper-gold ratio, and we got up to the point where now the 10-year Treasury interest rate is now higher than what's suggested by the copper-gold ratio, because copper and gold have had certain movements, and the 10-year Treasury has stayed close to 3%. Another metric that we like to use is, it's kind of wonky, it's the average of nominal GDP and the German 10-year yield, and there's weird reasons why I use the German 10-year, I won't go into it. But that too was suggesting that the 10-year Treasury needs to be a lot higher, like at 3%. Well, that's changed. And now we see that metric is now suggesting that the 10-year Treasury should be in more below 2.5%. So there's some of the things that were strongly suggestive of this yield explosion higher from September of last year into, say, earlier, just last week. A lot of those things are no longer sending the same sort of warning signals. So these are fundamental reasons why I think that it's, after the worst 4 markets, 4 months in a row, cumulatively in the bond market, it's not time to turn bearish. It's time to look for signs that the market has done a lot of heavy lifting already. And Jay Powell, I will give him credit for having corroborated that point of view in his press conference today.
Forgive me there, very interesting perspective from you. And I should let everybody know, too, we've got a bunch of people coming up to talk about what Jeffrey is telling us here. Also, what the Fed chair had to say. Josh Brown is going to join us. Some others we're getting on the line as well. But Jeffrey, before I let you run, and I know I have to unfortunately do that, you are in Buffalo today. People might not know the backdrop's a little bit different than it normally is, but that's your home. That's where you're from. And you've pledged tens of millions of dollars for an art museum, which I believe you're sitting in as we speak.
I'm sitting in the administrative building. The construction continues to be underway. We've finished the renovation of the 1905 building, which needed a lot of work because it was, there's a lot of deferred maintenance, so they call it, that's just disrepair. And then we had to remodel the 1962 building, and we're building the 2023 building, and we're going to be finishing that. I'm actually excited. I'm going on a tour next week, a hard hat tour. And it's really a lot of exciting things going on in Buffalo, and even the Bills look like they have a legitimate shot at the Super Bowl, which is this is going to be a great 12-month period in the city of Buffalo, I think.
All right. Well, congrats to you on that great project, the great work you're doing up there. June 15th. You got any plans? Because I want to do this again with you. Your reaction after the Fed meets.
Yeah, I'll tentatively do it. I have to check my calendar. I don't think.
All right.
I think I'm going to be back in Los Angeles then, so
All
we'll have
right.
a different backdrop.
All right. Well, I look forward to catching up with you again, and I thank you for your time today. That's Jeffrey Gundlach with DoubleLine. Be well.